Okay, so what I thought I'd do first is to just walk through the process of creating a pro forma financial statement. I know you all have read Chapter 19 and that went through it, but sometimes it's easy to get lost in the details, so I wanted to try to just hit the highlights, the high points. This is a really old slide deck that I've got, so forgive the fact that it's back from the dates are the last century, but the process is still good. So let me go full screen on this. And so, yeah, hopefully you saw that. Zach, thanks for being co-host there. All right. So I'm going to speed through this stuff for the most part. You know, what we're doing with the pro forma financial statement is trying to predict what the company's going to look like over the next few years. And we do this with one of two methods. One is called analysis of accounts method. This is a very detailed method, very time consuming, and is probably something that some of you may end up having to do, particularly if you're dealing with some sort of cash budgeting. You need to know what the exact cash flows are going to be in any given month. So that you can make sure that the firm has sufficient resources to make payroll and budget and all the cash expenses, because our cash inflows and outflows vary from month to month. And so that's the sort of thing that you would do if you were managing short-term assets. But the one that we're going to focus on is called the percent of sales method, and it's a much more general method. You can take it to various degrees of fine tuning, and so you can kind of come to something in the middle between this analysis of accounts, which is really for a analyst, from a security analyst perspective, is unnecessary, but you can go a little bit further than this slideshow actually suggests. So the way this works is we take many of the accounts as a percent of sales, and we're going to use the historical relation. And we're going to begin with coming up with a comparative or common size income statement, which, by the way, you can download the common size income statement directly from Bloomberg. So you don't even have to calculate that yourself. That's something you can get off of Bloomberg. And we're going to take a number of the balance sheet accounts as a percent of sales as well. Now, you can get a common size balance sheet off of Bloomberg, but remember, the common size balance sheet is as a percent of assets, not as a percent of sales. So we'll have to create our own percentages for the balance sheet side of things. Next step, we want to calculate some sort of forecasted sales growth rate. And again, that's something that maybe one of your other teammates are involved in right now. So, we'll take some sort of backward-looking historical trend or average, maybe even what's the word I'm looking for? We might even do a geometric average, something of that nature. Then you're adding to that the forward-looking stuff. And that's the most important part of your exercise as a security analyst. So once we've got that number, and by the way, we're going to make our spreadsheet that we're constructing here today as flexible as possible. So, you don't need the number today. We're going to build the spreadsheet such that whenever you've got that number, you just plug it in and the spreadsheet updates and everything is correct. Strengths and weaknesses, it's simple. It may suffice, and for our purposes, it will suffice. Weaknesses, it assumes that all costs vary with sales. We know that that's not always the case. And it also, assumes that all of the or portions of the balance sheet vary with costs, or vary with sales, rather. And that's not always true. All right. Just keep slipping by this stuff, so I want to get to the example. All right, so here's the example. As I said, sorry for this being a century back from the last century, but so we're at December 31, 1997, and we're trying to project into the future, into 98. And so how come this thing is not working? Come on. Hello. All right. So first we're going to do our common size, and we're going to restate everything in terms of percent of revenue. So we do that for our balance sheet. We do cash, accounts receivable, inventory, fixed assets. We do our accounts payable as well. We're not going to touch the long-term debt piece of it. And then we also do all of the expenses as a percent of sales. So here is here's what the balance sheet looks like, and down below is what the income statement looks like. So if we start down here, oops. Let me just start up at on the balance sheet. So that 250 in cash is 13% of sales, right? Our sales are 2,000, so 250 is 13% of 2,000. The accounts receivable is 2,000, so our sales, so of course that's 100% of sales, and so on down the line here. Then we come to liabilities and equity. The only thing that we're going to have vary on the liability and equity side directly with sales is accounts payable. So, you know, we're thinking current assets and current liabilities are the more critical things here. And then we go down to the income statement, and everything is stated as a percent of sales. And sorry, on my laptop I can't mark easily, so just follow on the page there, if you will. All right, does that all make sense? Then we're going to estimate sales for 1998. And let's just pick a number, 5%. And we're going to multiply all of those figures by that amount. So if our cash was 13% of sales in 97, it's going to be 13% of sales in 98, and so on. So here's an updated version. You see on the far right, there's our 1998 projected figures on a sales of 2,100. All right, so sales is up 5%. So you see our cash is up to 263. It's still 13% of the 2,100 now. Accounts receivable is 100% of 98 revenues, so 2,100, and so on down the line. And then our accounts payable are also 2,100, which is they were varying historically with they were 100% of revenues. And then you see our income statement likewise. So there are a couple of ways you could actually do this in a spreadsheet, and when I get to my spreadsheet, I'll show you one method. But you can see that you could either take you could take 100% times the new revenue is certainly one way to approach this.
Dr. Elliott, sorry
Yeah,
to
sure.
do there, but so that 5%,
Right.
is that what we're using kind of like our market analysis information to make that number? Like that's
Yeah.
we're making that number up, so we're using the information from our like competitors, from the market analysis and stuff to
Exactly.
where our sales are going.
Yes. Yeah. Yeah, and that's something that maybe a teammate is working on, right? So we don't have that number, but we're gonna pick a number and use it. So usually when I build a spreadsheet, I try to pick a round number so it's easy to tell if I've made a mistake in a formula. So if you pick like 10%, you can always see whether the numbers are adding up correctly or not. But yep, that's going to come out of that estimation of a growth rate for Sprouts. Then we come over here and we've got to deal with some of the other accounts on the balance sheet. All right. So, and again, this is up to you guys as to how detailed you want to go in this. And I'll show you on the spreadsheet that I created for Sprouts. I went into a little bit more detail than this slide deck is showing you. But in this particular example, we said, well, let's just let bank loans, long-term debt, common stock, and retained earnings come straight across. So we're going to use the 97 figures in 98. Now, in just a minute, we're going to make some adjustments to those. But for the moment, let's just bring them over directly from the historical numbers. All right? So now we've got values in all of our accounts for both the balance sheet and the income statement. Then we have to make an adjustment because, remember, retained earnings on the balance sheet is all of the net income that hasn't been paid out to the shareholders, right, historically. So if you look back here, right here, we've got a retained earnings of $5,750 at the end of 97. Now, we take the income that we had in 98, and that gets added to the retained earnings balance on the 98 balance sheet. So we've got to change that figure. And since here we've got net income that was 33% of sales. Now this particular company, we're assuming it has a dividend. Sprouts, you don't have to worry about a dividend, right? So that's one good thing about Sprouts. Any net income goes straight into the retained earnings account because they don't pay a dividend. In this example, we're assuming a dividend of 50%. So we take 50% of the net income, which is 33% of revenues, and we add that to the retained earnings account. We do that with a formula so that no matter what we do with revenue, our retained earnings is always updated correctly. So in this case, that formula will add $345 to the retained earnings account. So it'll go from $5,750 to $6,095. And you see that here. Now that red figure of $6,095 is not hard-coded, right? That's a formula. And that's, again, however you want to build the formula, there are multiple ways you could write that. But one way to do it is to reference back to the 97 value, the 5750, and add to it 50% of 33% of revenue, right? So 0.5 times 0.33 times the revenue in 98 added to the 5750 should give you that 6,095. All right, and then one other thing that we have a problem with here is that we still need to make our balance sheet balance. And because we brought some figures straight over from 97 and then we've done the update to the retained earnings, we've let current assets vary with sales. We've only let one of the liability accounts vary with sales, that is the accounts payable. We're going to have to do something to force the balance sheet to balance. There are a couple of ways we can proceed with that. One is to put it all into long-term debt, use debt financing to balance the balance sheet. Another way is to use all bank debt, and another way is to do some sort of combination of the two and add to it equity as well. So this particular example says, well, let's just assume that we're going to keep the same capital structure. So if we have, in this case, we have, what is our, let's see, we have 47% long-term debt supporting the assets. The other 53% is supported with equity. So what we're going to do is we're going to add to the long-term debt account. We're going to make, in fact, we're going to make that account have the value of 47% of the total assets minus the bank loans minus the accounts payable. And then when I look at total liabilities, which is the sum of long-term debt plus bank loans plus accounts payable, it should add up to 47% of the total assets. All right? And then I do the same sort of operation with equity. So my equity is supposed to be 53% of total assets. So I'm going to make the common stock account value be 0.53 times the assets. Then I'm going to subtract off retained earnings. And so when I come to calculate my total equity account value, it's going to be that common stock account plus retained earnings, and the two should add up to 53% of the total assets. And then when I add total equity to total liabilities, it should add up exactly to the asset value. And lo and behold, yes, it does. So we have an asset value of $15,488, and that's because we have used this long-term debt as a plug figure or as a formula, and we've also changed the common stock to force that balance. That's one of the most critical pieces of this, is you're going to have to force your balance sheet to balance. And we don't want to have to do that mechanically because we're going to be changing numbers all the time, and we want it to automatically update. Also, one of the things you're potentially going to run into, this is also the spot where you usually get that that circular error on a. I don't know if when you've done Excel formulas, sometimes you'll get a circular error where one thing is dependent upon another, but it's also dependent upon that first thing. And you get this, so you'll have to be very careful the way you write this. It's easy to get these circular errors, and you don't want those. It's not a good thing. All right, so that's pretty much it in a nutshell. Now let me show you the spreadsheet I put together. But before I do that, any questions that you all have? That's kind of the overview of the process, though. Everybody okay?
Are these slides on Canvas?
They aren't. I am recording this, and I can upload these for sure. Yeah.
That works too. It's whatever is easiest for you.
Yeah. Yeah, I think maybe the recording, I'll do both. Yep. All right, so let me go to the spreadsheet. All right, so what I've done here, I went to Bloomberg, and I don't know whether you all have played around with exporting from Bloomberg. Doing it remotely is a little tricky. I was finding that because Bloomberg uses, when they create an Excel spreadsheet for you, they use code that automatically updates in real time from the data feed. And as soon as you're unplugged from the data feed, all of a sudden you've got these, errors in the cells. So what I was doing was I was copying and pasting using special paste. So I pasted values. So you can get around that if you have that problem. I think when you're at the physical terminal, it's not a big deal. But I was running into that. So be aware that you might run into that. If you do a copy and then a special paste and then pick values only, that will get around the issue that you don't need to have this thing connected directly to Bloomberg Live all the time to have the data on your spreadsheet. So what I did was I went back here. These are all the accounts that Bloomberg gives us. I've cleaned it up a little bit and removed some of the accounts where there was a zero balance for all the years or there were dashes. So I consolidated this a bit more than what Bloomberg normally has. And this particular one is the, let me jump actually back to my first, here we are. So we are on the income statement here. And this one is just the dollar value. It's the adjusted income statement. I also downloaded the common size income statement, and you can see that over here. So what I did here was I actually, hang on a second. I didn't save that. What I did here was I actually took the common size income statement and I did some averages. So I was getting the average percent that cost of revenue is on the 5 years, most recent 5 years. And I did it for a 2-year period, and I also did it just for the most recent. So if you look here in column F, that's our most recent year. So cost of goods is 63.2% of revenue. So in other words, 4,027 or 4 billion actually, $4,027 million is 63.2% of the 6.468 billion in revenue. So that's that figure right there. I did an average for 2 years, so I averaged over 2019 as well as 2020. And then I also did a 5-year average. So I went all the way back to 2016, 17, 18, 19, and 20. I thought that'd just give me a little bit more ability to play around with this. If there were any strange things going on in the way these accounts relate to one another over that period of time. And you might notice that in 2019, something did happen. I'm going to leave it up to you to figure out what that is. But there were some significant changes, right? You'll see this as we go through the numbers here. All right, so I've got my regular numbers, the actual dollar values, and then over here in column G, H, and I have common size, in other words, as a percent of revenue over various windows. All right, so that's the income statement. The balance sheet, a common size balance sheet always takes things as a percent of assets, and that's not what we want here. We want the some of the balance sheet items as a percent of sales, as a percent of revenue. So we're going to have to create that ourselves. So I pulled this out of Bloomberg as well, and I just needed this for the dollar values. And then I made another spreadsheet where I created the balance sheet as a percent of revenue. So the green, can you see that green? It doesn't show up on the screen here, at least that I can see. Hang on a sec. Oops. Does that look green to you? Oh, it does. Okay. I'm just not seeing it in the small image. It does in my recording too. All right. So what I've done is I've shaded all of the accounts a light green where I was computing those as a percent of revenue. So these are my current asset accounts, right? So I've got cash, I've got accounts receivable, I've got inventory, and then I've got a total for the current assets down here. And so depending upon the year, they vary from 7.2% down to 6.4%. And remember, this is of revenue, of sales, not of assets. All right, and then down below here, I've got plant, property, and equipment. I've got other long-term assets, and then the total for all the other non-current assets is what Bloomberg states what they call them. Think of them as long-term assets, right? Same thing. And then the final line down here is the total of the long-term assets and the current assets. All right. And then down here, I've taken the accounts payable, and I've done that as a percent as well. So again, anything in that light green is as a percent of revenues. And then I've got my dollar values for the other current liabilities, the non-current liabilities, and then down at the bottom here, down at the bottom here is my equity. And then the total of the total of liabilities and equity. All right. And then over here again in columns H, I, and J, I've done these same things. I've done this 5-year average, I've done a 2-year average, and then I've done just the most recent year. And I've got the percentage values for each of those. All right, questions so far? This is kind of the setup. One other thing that I did just for grins, it doesn't make things too complicated. I don't know how many of you have used this choose function in Excel. Have you tried that out? It's kind of a cool little function. I'd never used it really either myself, but you'll see up here CHOOSE. And what you can use that for is what I'm using it for is choosing either to use column H, I, or J as my percentage. So for instance, when I'm calculating what my cash balance is for 2021, I'm using this choose function, and I'm using the third column, which is in this case J. So here is my index. So this is where I pick which column I want to use. So if I watch what happens when I change this to a 1, and you'll see the cash balance change. All right. And when I change it back to a 3, it should switch back. So the cool thing about this is that, so there's my I2 is my index, and then I'm either picking H10, I10, or J10 based upon what's in I2. All right, and I do that actually for all of these that vary as a percent of revenue. You'll see the choose. So once I've written the choose function once, I just copy things down. You don't have to do that, but I thought it was kind of that way I can play around with what the historical percent of revenue is without too much trouble. In fact, if I wanted to plug something entirely different in here, I could switch that around. So if you wanted to get a little more detailed and say, oh, wait a minute, costs of goods I think are going to change differently than they did in the past, well, you can plug that in and see how that changes your cash flows. All right. And I did the same thing over here on the income statement. So you'll see that there's my choose function right here. And again, that refers up to this index, and then it just picks, either the 5-year average, the 2-year average, or the most recent. And of course, with revenue, that's always 100%. But with these others here, with cost of goods, I've got either, between 63 and almost 66% here. So I can swap that around pretty easily. And this particular one, I've just picked 2. I picked the 2-year average. In the balance sheet, I picked the most recent. All right. So we've got that going. I brought on the balance sheet, other long-term assets. I'm just plugging them straight over. So I took the most recent, the 2020, and plugged it in over here for 2021, 22, 23, 24, and I went all the way out to 25. All right. Is that a reasonable assumption? I don't know. That's up to you to decide. But it's a starting point, right? It lets me build my spreadsheet. And then if you want to make some changes to even these other figures that I'm just plugging straight across, you can always change those. By the way, I should also point out that in building this thing, even though I brought all of this data across from Bloomberg, and Bloomberg has already summed up the total current assets, for example, I've actually made this an equation in Excel. If you take it as a fixed figure coming out of Bloomberg, that's not going to work. So any of these that are sums of the sub-accounts, you want to hard code that in, or not hard, you want to code that into Excel as a function, as an equation. So here I have added up the other short-term assets, the inventory, the accounts receivable, and the cash. And that value comes out as my total current assets. And I want to do that with all of these subtotals. So I did the same thing here. So the total non-current assets, oops, what happened? How come it's frozen up on me? Total non-current assets is the PPE and the other long-term assets. And then total assets is the total non-current assets plus the total current assets, and so on. And I did the same thing with liabilities, and I did the same thing with equities, and I also did this over on the income statement. So for instance, instead of just being a number, this is actually a formula. Okay? Questions so far? All right, good. Next thing. I said, well, let's have our growth expectations up here. And rather than make it just one growth rate for the entire 5-year period, I'm actually going to allow myself to vary the growth rate in each year. You don't have to do that, but it gives you more flexibility. So along here in row 3, I've got my growth rates. And the way those work is that they just go straight down to here. So I took the 2020 revenue times 1 plus my 2%, or my cell reference here, just happens to be 2 at this point, and that becomes my new revenue for 2021. And then this one I decided to grow at 5%, and the last 3 I decided to grow just at 4%. And obviously, this the 2022 references the 21 revenue, and it grows it at 5%. And so on for 23, 24, and 25. I also built in the ability to change my interest costs because I felt that since we're going to be changing long-term debt as a plug figure to make our balance sheet balance, I wanted to allow interest costs to vary not as a percent of sales, but directly related to my total long-term debt. So here again, this cell up here, interest cost, I just pulled a number out of the air just for demonstration purposes. You could actually go to Bloomberg and analyze what the cost of debt is and figure out what the current average cost of debt is and what they would be if they took on new debt, what that would cost them and so on, and come up with a much better figure. I just pulled out of the air 5%. And now that goes down here. So here what I've done is I've referenced the balance sheet. So I'm looking at my total long-term debt figure here on the balance sheet in cell K45. Let me highlight that whole thing. So I've referenced the balance sheet, cell K45. If we go over to K45, there it is. There's my total long-term debt. All right. Let me come back here. And then I'm multiplying that by my 5%. So my interest figure here is actually related directly to the balance sheet and my cost of long-term debt. And again, whether you do this or not depends upon whether you think that's an important figure to have. And the rest of it is pretty much, that's it. That's all I've really done on the income statement. Now we go over to the balance sheet. We've got a few more things to deal with on the balance sheet. So here, let me go with the first thing that we saw in the slide deck, the retained earnings. So we're going to go down here to the equities piece. And here is our retained earnings. And notice that the retained earnings comes from the income statement, cell J24, which is net income. And since we don't pay out any dividends, the entire amount comes over to become part of the retained earnings on the balance sheet. And I'm adding that to my prior balance, which in this case is in cell G50. So that was the 2020 retained earnings. When I add the new income, I come up with a new retained earnings for 21 of 381. And I do the same thing for 22, 23, 24, and 25. All right. So now I've taken care of that interaction. Another thing I was looking at here, and again, as an analyst, you're welcome to look at all of these things and say, well, wait a minute, something looks funny here. Maybe I should do something a little more robust to deal with that. And one of the things that I noticed here was as I was looking at plant, property, and equipment, and again, I've consolidated these. They're operating leases, they're long-term leases, and I want you to dig into that, but I'm doing this just for demonstration purposes. So I noticed that in 2016, 17, and 18, my PPE was, somewhere in the 600 to 700 range. And all of a sudden, 2019, it pops up by $1 billion. And it stays at that level for 2020. So I thought, well, you know what? Maybe I'm going to make an assumption that I'm going to continue to increase my PPE. And I also want to deal with accumulated depreciation. So you'll notice I color-coded up here. So I've got an assumed increase in plant, property, and equipment. And I've just, again, making up numbers. This is not a recommendation to you. I have not done all of my due diligence on Sprouts. So I'm just giving you an example. I don't even know that this is appropriate, but I'm just giving you some ideas of what you could do. So here I said, well, let me increase PPE by $400 million every year. And I'm going to continue with an accumulated depreciation of about 130 every year. So you'll see here that this figure is this net PPE is plant, property, and equipment minus accumulated depreciation. And my PPE itself is last year's plus this increase over here of 400. And then my depreciation, accumulated depreciation, again, is last year's plus the addition of 130 million. Should that change over time, particularly since I'm adding new capital? Yes. And you could make it a little more realistic by doing something like that. But again, I just want to give you an example. All right, so you'll see that as I go through time, I'm increasing my plant, property, and equipment. Here's one example of why you might want to do that. Let's say, and again, I haven't done all my reading. Maybe you guys are even ahead of me on this, I hope. Let's say that Sprouts is planning on growing its footprint by 20% over the next couple of years. Well, obviously, I'm going to increase PPE. So we want to make this balance sheet as close to realistic as possible. And the reason I want to do that is that, by increasing PPE, that means I'm going to have to fund that somehow. I'm going to have to use long-term debt and or equity. And long-term debt is going to cost me in terms of interest costs, and that's going to affect my net income and so on. So again, it's up to you to make these decisions. So now I've got my PPE in there. I've dealt with my retained earnings. I've got the accounts that vary with revenue. So I've got my current assets, and I've got my accounts payable down here. All right. Then one last step. I still have to make my balance sheet balance. And you'll notice up here, my balance sheet does happen to balance. I put the two values up here. So total assets, $3,085,000,000. Total liabilities and equities, $3,085,000,000. I've already created the formula. And this is just a handy way of checking that my formula is right. So I put it all in one spot where I can easily look back up here and go, oops, I got to switch something around. It's not working quite as I thought it would. So that's kind of a handy thing to have up there. But you'll notice that all of these balance. And if I change something, like let's say I change accumulated depreciation to 200 per year, you'll notice that when I make that change, the balance sheet changes, the total assets change, but it still balances. So that means I'm in pretty good shape. If I went over to the income statement and changed my growth rate of revenue, the balance sheet would change and it would still balance. That's what you're after. I don't want to have to touch anything. I want to be able to start playing around with my inputs and have everything flow through both the income statement and the balance sheet without problems. Okay, so I'll go back to 130. And so here are the two cells, or the two rows rather, that are creating the magic. I made the assumption that I'm going to keep capital structure where it is. Is that a good assumption? I don't know. You got to read about what management thinks. Do they think they're under leveraged? Are they over leveraged? So you're going to use the input from management to make these decisions. What I have decided was, for this kind of uninformed spreadsheet, I'm going to assume we're going to keep the amount of leverage at the same level as it was in 2020. And again, I color-coded these things to make it easier to look at. So here in row 45, that relates up here to Q1, which is where I've got the debt to assets. So that's my leverage. So 68.6% of assets are supported with debt financing. All right. Now, what I'm going to do here is I want to use my long-term debt to help the liabilities side balance. And that formula, what it's doing is it's saying, well, let me take my debt, my leverage ratio, times the assets, that's K30. All right. So if I go up, let me see, scroll up here. Oops, sorry. So if I scroll up here, there's K30. So $3,085,000,000 is my total assets. So I'm taking 68%, 68.6% of that, and then I'm subtracting from that K44, which is total current liabilities, and K46, which is other long-term liabilities. So when I add those three together to get my total liabilities down here, I'm going to end up with those total liabilities being exactly 68.6% of assets. And then I'm also changing my paid-in capital to force the equity side of it to balance out correctly. So the equity piece is going to be, 31.4% of assets. So you'll notice here I've got 1 minus Q1. So there's my 31.4%. And multiplied again by K30, which is my total assets. And then I'm going to subtract off K50 and K51, which is my retained earnings account and my other equity account here. So by the time I add up my retained earnings, other equity, and the paid-in capital and the common stock, I'm going to end up with exactly 31.4% of the assets. And then when I add the equity with the liabilities, that's going to exactly equal the assets. And again, I don't have to, once I've written these formulas, I can change the growth rate assumptions, I can change other assumptions in the spreadsheet. I don't have to worry about the balance sheet balancing. It's going to do it automatically. Now, one last thing to talk about is, well, wait a minute. What am I doing to my common stock? Well, the way it looks right now, since my retained earnings is going up fairly rapidly because I don't pay out any dividends, what it looks like I could be doing, and again, this is something that you'll want to explore as you read about Sprouts and what they do, but does Sprouts do any buybacks? Because look here, look at this value. I'm going from 596 million to 506 to 414 to 319 to 223. So I'm buying back stock like crazy. Or at least that's the assumption that's built into this current spreadsheet. Is that a good assumption? Is that what management is doing? Then I'd be okay. If it's not, then I might want to change my spreadsheet around to reflect what management is actually doing. And maybe I only want to fund this with leverage, with debt. And again, that's up to you to research. So what you might do is you might just build the spreadsheet, and then you can tweak it here and there as you learn more about the company. I'd recommend getting started on this, though, sooner rather than later, because, I built this one this morning. Took me a couple of hours as I was playing around with it. So, and getting the data cleaned up out of Bloomberg and removing some of the accounts that were meaningless, making sure I had sums instead of the number coded in and the subtotals and things of that nature. It took a few hours to put this together. So, make sure you allow yourself plenty of time. Get it built, get the basics working, and then you can always come back and fine-tune it. I think that's pretty much what I wanted to go over with you all. Other questions that you may have? Sorry. Yeah, go ahead. Who?
On the form you have on Canvas, it says at the very end for this statements, use the relative value for the terminal at the end of 2025. What does that mean?
Yeah, and actually, good. I'm glad you asked that, because I was going to skip over the last but still very important piece of it, which is, let's come back here. And I didn't do this in this one. It's fairly easy to do. What I really need to do down here, once I've got my net income, I need to calculate my cash flows to the firm. Let's just get free cash flow to the firm. And we're going to get free cash flow to the firm here, free cash flow to the firm here, and free cash flow to the firm here. All right. Then, Sean, what you were asking about is ongoing value of the firm. right? Because we've got 5 years of free cash flows, and we still need the ongoing value of the firm. So I could use some sort of, again, I could use the free cash flows that I have estimated for 2025, and I could project that out into 2026. So let me say this is free cash flow to the firm for 2026, multiplied by some expectation that I have for the value, enterprise value of the firm to free cash flow to the firm. And that will give me the ongoing value of the firm. So now I take this figure that I have in cell N28, and I add it to this figure that I have up in N26, and that's, so I've got ongoing value plus the 2025 value. All right, so now I've got this cash flow. Let me just change the color on these things. I've got, that's a bad color. There we go. I've got that cash flow, and I've got these other 4 cash flows. Now what I want to do is I want to discount all of these things, all 4 of these, plus this terminal value plus the final cash flow at my cost of capital. And then I sum all of that up, and that gives me the enterprise, or sorry, not enterprise value, that gives me the value of the equity and the debt. And then I subtract from that the market value of the debt, and I end up with the market value of the equity. I should have had that all written out and an example of that for you all, but this last part of the step actually is pretty basic, right? We're calculating a free cash flow here. So we just start with your net income, add back your depreciation, add back any other non-cash expenses that you've deducted from income. Then you subtract off of that any expenditures, capital expenditures. Add back to it any stock increases in stock. So if you're issuing stock, in our case we aren't, but if you're issuing debt, which we are, you'll add that back in. Come up with this free cash flow, and do that for all 5 years. Use that final free cash flow as an estimate of the 2026 free cash flow, and get an ongoing value of the firm using that relative valuation multiple. Add that together with that final free cash flow. Discount all 5 of these back at whatever you guys come up with as a cost of capital. And again, don't hard code in numbers. Do that as formulas so that you can change whatever the cost of capital is. And by the way, remember, this should be the cost of the asset risk, not the cost of equity, right? Because we're discounting both the cash flows to debt as well as to equity here. And then from that, we end up with the value of the firm, but that's both debt and equity. So we need to go back to Bloomberg, figure out what the market value of the debt is, subtract that off, and we are left with the market value of equity. Make sense? Does that help, Sean?
Yeah, thank you.
Mm-hmm. Sure. What else?
I know you said that you'd be sharing the slides. Is there any chance you're gonna upload the Excel spreadsheet as well?
I've been thinking about that. I think the answer is
I know that might be a controversial question.
yeah.
I figured I'd ask in case.
Hey, you can't. It can't hurt. I think the answer to that right now is a no. I want you guys to work through it your own way. It doesn't have to look like mine by any stretch. Do it however, whatever makes sense for you guys. I didn't make mine particularly pretty. You could probably have one sheet that has all of your assumptions built into it, and another sheet that has the income statement, another sheet with the balance sheet on it. So I think I'm going to leave it to you to work with this. Certainly, you can come back to the video and look at equations.
Okay, yeah, no, it was just for the equation purposes.
Yeah.
So revisiting the video was all.
Yeah. Yeah, I'd say go back and review that. Yeah, I don't want to give you any sort of formulaic because, for instance, maybe I'm wrong about how we're going to fund this change in assets. Maybe it's much bigger or much smaller than my expectations here. Like I said, I have not updated myself on the company, so I haven't done my part of the analysis, which is to figure out where the company's heading. I've just given you some examples of what the company might be doing. So yeah, maybe the PPE is totally off, which would mean that then my debt piece is totally off. So I don't want to impose any of these biases on what you all do as analysts. What else? Everybody ready to go out and play on spreadsheets then, sounds like? I'll try to get this video uploaded shortly. I'll cut out some of my faux pas, and it'll be up on YouTube. And I've got the link. I think it's in one of the announcements. So if you don't have it handy, just look back through the announcements, and you'll find the YouTube channel link. I've got everything, including. I'll put this in the same spot as the other lectures are. But other than that, unless there are any other questions, I think that's it from me. See you all on Tuesday then. Thanks.
Thank you. Have a good one.
You're welcome.
Thank you.
Bye-bye. You too.